Thank you so much. It's such a pleasure to be here. I'm really excited to talk to all of you today about the thing that has been my great obsession for the past 4 years or so, which is cyber insurance. I'm also struck right now by how different it is to hear the little privacy intro around recording when you're speaking to a group in Europe, and how much more conscientious that is. And I think sort of one of the things I've been really thinking about with this project is some of these broader differences, not just in approaches to privacy, but also in approaches to cyber risk management and approaches to thinking about the privatization of cyber risk management between the United States, where cyber insurance has really taken off, and the EU, where it's been a much slower start. And there's been a sort of, I would say, a little bit more friction around this market. So I'm going to talk to you today a little bit about this new book that Volker mentioned. It came out last month. It's really sort of my attempt to do three things. It's my attempt to tell a story about the history and the emergence of cyber insurance. When does it start? How does it change over time? Because one of the things I think is really interesting about this space is how quickly these offerings change, right? How quickly we go from 25 years ago, when you can buy some coverage for paying lawyers in the event of a data breach, to coverage today where you are asking for coverage for ransom payments, where you are thinking about business interruption costs, where you are thinking about paying the people who are going to negotiate with your attackers and all of that sort of thing. And so I'm interested in that history. The second part is really a sort of set of 3 chapters looking at disputes and disputed claims in cyber insurance, and trying to understand what are the fights that policyholders get into with their insurers, and what do those fights suggest to us about why this might be a tricky kind of risk to insure. So I talk about 3 different sets of fights. I talk about fights around commercial general liability insurance. I talk about fights around cyber crime insurance, and I talk about fights around property and casualty insurance. And what I'm going to talk about today is mostly those fights around property and casualty insurance, and how they kind of shape the ways that policyholders and insurers are thinking about what they do and don't cover. And then finally, the last section of the book is sort of thinking about policy, and policy in the sense of public policy, not cyber insurance policies, and trying to understand, is there a role here for regulators? What would that look like? Given how heavily regulated insurance is in general, what are some lessons we might be able to draw from other fields of insurance? And fundamentally, I would say, kind of the question I try to get at in that section and in the book at large is the question of sort of how is cyber risk different, or is cyber risk different from all these other types of expensive risk that we've on the whole managed reasonably well with insurance tools? Is it different from thinking about natural disasters, from thinking about traditional crime, from thinking about fires and other types of risk that we've seen the insurance industry, pretty effectively manage to deal with for most consumers? And that's sort of the question at the heart of this to me, is can we use the insurance tools we have, and which parts of them are useful and which parts of them are not? And if they're not useful, which is one of the things I talk about quite a bit, then why not? What's so different, what's so hard about this type of risk? So I want to mostly focus on sort of war exclusions and the questions of how we understand the cyber attacks that insurers refuse to cover and why those are somewhat controversial. But I do want to start with a little bit of history. I want to start with this guy, Steve Haas, who designs the first cyber insurance policy. That is the first insurance policy designed specifically for cyber risk. It's launched at a big party in Hawaii in 1997. It's called the Breach on the Beach Party. It's at a big insurance convention. And I just want to give you a sense of sort of how far this industry has come in the past 25 years. So this is the original internet security liability insurance policy that Steve Haas designs. It would provide coverage of up to $250,000 in legal costs and settlement fees if customer credit card numbers are stolen off of a company's servers and the credit card company then sues the firm. Right, so you see this a lot in the early 2000s. There are a bunch of data breach notification laws being passed in the United States. There's the Data Protection Directive being implemented in all of the countries in the EU. A lot of companies are starting to worry about what happens if there's some breach of personal information, especially in the US, which I think it will probably not surprise you to hear is a more litigious culture for the most part than most of the EU countries. There's this real fear of litigation, right? If I have millions of credit card numbers stolen off of my servers, there's maybe some cost in notifying people and some reputational cost and all of that, but the real costs are going to come if somebody gets a lawyer and tries to file a class action suit. And so this is an insurance policy really designed to deal with those, what we would call third-party costs, right? Third-party costs, meaning it's not a direct loss to me because of the breach. It's a third party, the lawyers, who I'm going to have to hire and pay quite a lot of money in some cases to protect me against this lawsuit. The premium for this plan in 1997 was $2,500 annually. But you could get a discount if you went to the National Computer Security Association and they did an audit of your security and they certified you as secure, then that would bring the cost down to $1,875 per year. And I give you these numbers just a little bit as sort of a landmark, so that as we move forward and think about the growth of this industry, which is now sort of around the $7 or $8 billion a year in premiums size, we have some sense of where it starts, what people think data breaches are going to cost, or what we think sort of a reasonable amount of coverage for them is going to look like 25 years ago, what kind of risks we're worried about, which is really breaches of personal information. And I think that's very closely linked to the public policy landscape, the fact that that is what regulators are requiring companies to report. And so that is the thing we are reading about in the newspapers, hearing about from companies, the thing that, dictates which companies are concerned about cybersecurity. It's largely retailers, other folks who are collecting payment card numbers. And in the 2.5 decades that follow, our sense of how many risks are involved is going to really expand. Our sense of how many companies should be worried about these risks is also going to really expand. So you get not just retailers buying policies, you get not just policies that are covering data breaches and the legal costs, but a whole bunch of other first-party costs as well. The other thing I want to flag for you here is that there's this fairly substantial discount that you get in 1997 if you're willing to submit to a couple days of auditing by the National Computer Security Association. And this is one of the things today that you see a lot of frustration on the part of policyholders with, the sense that, we invested so much money in security and the insurer didn't look at that at all. They just sent us this long questionnaire and then the premiums went up because the premiums have all been going up for the past couple years. And so you start out with this much smaller market, of course, but also a little bit more ability to do some of this in-depth auditing. You start out with the insurers trusting that audit a little bit more, perhaps, than they do today. And also, of course, you start out with much lower limits, even though still today many policyholders feel the limits are too low. So that's the first thing I want to tell you about the history of cyber insurance. And the other thing I want to flag, because I do think it's important for understanding how quickly this expands and why insurers go from this very limited model to the much sort of richer and more complicated cyber insurance market we have today, is that for a long time, it's an incredibly profitable product for insurers, right? So if you think about, and this is just 4 years ago, these numbers come from, how profitable a cyber policy is for a typical insurance firm, the loss ratio for cyber policies in the US was about 35% in 2018. So that means for every dollar in premiums that an insurer collected, they only had to pay out 35 cents. They were making in pure profit 65 cents on each dollar. And you compare that to like these much bigger insurance sectors like property and casualty, those all have much higher loss ratios. So here's the numbers for property and casualty that same year, 62%, right? You're paying out almost twice as much per dollar premium collected in property and casualty. Of course, property and casualty is also a much bigger market, right? So it's in the hundreds of billions of dollars in premiums every year compared to $6 or $7 billion in premiums for cyber insurance. But I think that will give you some sense of why so many insurers are so aggressively expanding their cyber portfolio right up until a few years ago when it starts to sort of retract a little bit. And also why they're willing to kind of keep covering more different types of risk, right? Even though they know, most of them, when you talk to them, we're a little unsure. Our models really capture stuff. We don't have great data to work from, but we're making money, right? We're not seeing anything, really frightening happen. right up until 2019 when you get this big surge in ransomware and the insurers start to get scared and start to raise premiums and sort of rethink the way that they're doing some of this. So that sets the stage a little for some of the more recent fights that I want to talk about in insurance. You do see this shift come in 2019 and 2020, and I'm going to come back to that. But first, I want to go back a little before that to 2017 and to NotPetya. So as I'm sure most, if not all of you remember, in the summer of 2017, we've just come off of recovering from WannaCry and the UK National Health Service and others, being really hard hit by ransomware. And we start to see this new malware in late June. We notice it first in Ukraine. Here's one of the stories about the Ukrainian electric grid getting compromised, one of these sort of early targets of this malware that comes to be known as NotPetya. But it's not just Ukraine. We see this malware spreading all over the world. We see it affecting companies that operate, internationally. Here's the headline about the shipping company Maersk losing as much as $300 million because it had to shut down operations for 2 weeks. This is true of companies all over the world. And the losses, right? And this is important for insurers. The losses are huge compared to what we usually see around cyber attacks. And you all know there are sort of an endless number of stupid estimates around this cyber attack. This data breach costs X million dollars and whatnot. But when we're talking about NotPetya, we're talking about fairly concrete numbers because we're talking about a lot of companies that just have to stop everything they're doing. Right? We're talking about companies that can't ship, that can't manufacture vaccines, that can't do, any of the things they're supposed to be doing. And many of them by 2017, not all of them, have some decent insurance in place for this, right? It's already kind of enough of a product that people are aware of. It's already covering costs like business disruption. And so there's an opportunity there for some of them to file claims for some of these really large losses. I want to flag for you again, right? This is, we think, primarily directed at Ukraine, and that's going to matter to the insurers, especially once it gets attributed to Russia. This idea that this malware is part of an ongoing conflict, right? A conflict that at the time had not escalated to the point it has now, but was already in the eyes of some people because of the annexation of Crimea, a war that was already a sort of well-known and understood geopolitical conflict. It starts in Ukraine, but it spreads everywhere. It spreads to, all sorts of companies and all sorts of countries because of communications and connections between Ukrainian infrastructure and other countries. It looks at first, as many of you may recall, like ransomware. This is the screen that comes up when NotPetya downloads on your computer. It says all the things you might expect ransomware to say: send $300 worth of Bitcoin to the following address, and then send your Bitcoin wallet ID to this email address, wowsmith123456, and we'll send you back your decryption key. But people start to notice pretty quickly, this is not sort of standard ransomware, right? If you actually make this payment and email this email address and ask for a decryption key, you get back a message telling you that email address doesn't even exist, right? There's clearly no mechanism in place to make it possible for people to get back their money or to get back their data, rather. And so there's already sort of very early on some signs this is not traditional ransomware. This is not the thing we would expect if we were looking at cyber criminals who were trying to make money. This is followed a little while after by a fairly coordinated, I would say kind of the most coordinated attribution effort we've ever seen around a cyber attack. In the space of about a week in February of 2018, so a little more than like 6 months after the attack actually happens, you get a whole bunch of governments coming out and saying, we think this was the Russian military, right? Here's the National Cybersecurity Center in the UK, February 14th, 2018. The Russian military is almost certainly responsible for the destructive 2017 cyber attack. And this is, a new thing to have the UK, the White House, here's the White House statement that same week. In June 2017, the Russian military launched the most destructive and costly cyber attack in history. There's a real sense of all of these countries coming together to say this was the Russian government. We have performed attribution. We've consulted with each other. We've pooled our intelligence. We're really confident in this. It's not the first time we've ever seen a government attribute a cyber attack to another government, obviously. But it is one of the first times we've seen a lot of governments do it all together, right? And because of that, I think the insurers start thinking, okay, here's maybe a story where we're not going to have to fight a big attribution battle, right? Here is a story where everybody seems to be on the same page. This was Russia. And let's maybe think about, from our perspective, if we're going to choose a fight to pick around one of these really big cyber attacks, thinking about this one. And the other piece of that, of course, is what it says right here in the White House statement. It's the most destructive and costly cyber attack in history, right? The estimates of how much NotPetya costs and damages are on the order of $10 billion. So if you're an insurer, you're looking at this attack, you're saying, okay, this is maybe the most expensive breach we've ever seen. It's very scary for insurers because it cuts across every sector, right? It's not, one type of company. All of their efforts to sort of diversify their risk pools by signing on policyholders from a bunch of different company or industry sectors don't really help if you're dealing with malware that targets Microsoft Windows, which after all is, shared by every sector and every organization in the world. So the size of the costs frightens them. The inability to kind of single out a particular sector or say, if we just diversify our policyholders enough, then they won't all be hit by an attack like this, leaves the insurers feeling a little bit uneasy. But then they get these great attribution statements that I think really fuel what happens next. And what happens next is the insurers deny a few claims. One of those claims comes from this company, Mondelez International, which is a big multinational food company that produces a lot of snack foods and crackers that you may be familiar with. And Mondelez loses, they say, more than $100 million in the NotPetya attack, right? There's a sense that there's huge damage that's been done. The good news is they've negotiated a property insurance policy that covers all risk of physical loss or damage to their property, including physical loss or damage to electronic data, programs, or software that's caused by the malicious introduction of a machine code or instruction. So it's right there in the text. And I think this is really important because often when you hear people talk about cyber insurance, you'll hear them talk about this idea of silent cyber, right? The idea that people are just assuming, oh, cyber is covered in my property policy because it doesn't say it's not covered. But in the case of Mondelez, in the case of Merck, which is the other big case that comes out of NotPetya, it's actually very explicitly affirmatively covered. We're not saying, oh, you forgot to exclude cyber. It says right there in the policy, malware is covered. That's something that we'll pay for. And it also says very explicitly, we will cover any loss sustained and extra expense during a period of interruption directly resulting from the failure of electronic data processing equipment or media to operate. So there's, again, this really clear, we've negotiated in our big property policy that we have coverage for business interruption, and that we have coverage specifically for business interruption resulting from cyber attacks. I think that the other piece of this story that's a little in the weeds but really important is the question of why Mondelez and Merck and others go to their property insurers for this coverage, right? There's this big booming industry of standalone cyber policies that, cover everything from data breaches to ransomware. But here we're actually talking not about Mondelez's cyber insurance, which they also have, but about their property insurance. And the reason they go to their property insurer is because of these limits on cyber insurance, right? If you want to buy a cyber insurance policy, you're looking at $5, maybe $10 million in coverage. If you want more than that, you can go to a lot of different insurers and start stacking policies, but you're never going to get $1 billion in cyber insurance coverage, whereas companies routinely buy $1 billion in property and casualty insurance. So if you're really worried about large-scale risks, as many of these companies were, you want to go to your property policy. And then when you have a really expensive cyber attack, as NotPetya was, you can file a claim under your cyber insurance, and Mondelez and Merck both do that. And one of the things the insurers say in the aftermath is, well, you got your cyber insurance claim, why are you still asking for more money? And the answer is because we lost a lot more money than our cyber insurance would cover, right? It's a very small policy compared to the damage done by an attack like NotPetya. And in the eyes of these companies, these clauses in their property insurance policy mean that property insurance is also effectively cyber insurance of a sort. To give you a sense of the damage at Mondelez, right? Here's the company describing it themselves. They say the NotPetya infections in our network rendered 1,700 of our servers dysfunctional, 24,000 of our laptops dysfunctional. We incurred property damage, commercial supply and distribution disruptions, unfulfilled customer orders, reduced margins, other covered losses aggregating well in excess of $100 million. So this is the property insurance argument here, that we've incurred a very significant business disruption. It cost us more than $100 million. And the only way we're going to get that amount of money from our insurer is if we make this claim under our property and casualty insurance. Now, Mondelez's insurer, Zurich, comes back, and after, and I think this is really important, they first send a letter to Mondelez saying, okay, we're going to start processing this claim. And then after those February 2018 attribution statements I just showed you, they come back and they send a new letter that says, we're actually not processing this claim at all because we've realized that there's an exclusion in your policy that excludes any kind of coverage for hostile or warlike action, including action by any government or sovereign power. And we've just seen all of these different governments tell us that NotPetya was an action by a sovereign power. It's a very complicated exception, the war exclusion, right? It's not about cyber attacks particularly. It goes back a very long time. It has a pretty complicated legal history around what insurers are and aren't allowed to use it to exclude. And Mondelez, understandably, and Merck, which gets the same response from their property insurers, is pretty pissed off about this, right? So both companies end up suing their insurers, which is how we get sort of access to the legal documents about what all of their policies say and what the back and forth looks like between all of them. And in those lawsuits, there's a huge reliance on what's the precedent for this type of exclusion, what does and does not count as war. And I think it's important to distinguish here between sort of what does and does not count as war in a kind of theoretical or philosophical context, which is something that scholars in the cybersecurity space sometimes talk about. And in this case, what does or does not count as a warlike action in the context of a binding legal contract, right? So it's less of a sort of theoretical question once we start looking at these lawsuits, and much more of a, there needs to be a yes or no. Right? Don't tell me like cyber conflict is a spectrum and there are qualities like this or that. Either this insurance policy covers it or it doesn't. And I think that's actually a take on cyber war that certainly the scholarly community has not had to really answer before. There are a whole bunch of kind of popular press designations that people point to at this point, right? Andy Greenberg is probably the premier journalist covering NotPetya. This is his big Wired cover for the story he wrote about it. He later wrote the book Sandworm about it. Says in this article, the release of NotPetya was an act of cyber war by almost any definition, right? So he's saying there are two sovereign countries. They're already engaged in conflict. One is attacking another. What more do you want, right? What else could cyber war possibly be? On the other hand, there's a long legal history of courts pushing back against the idea that just because something kind of looks like war, it necessarily is. And I want to give you just a brief flavor of that legal history, and then I'll wrap up and we'll shift to discussion. But I just think it's important to understand sort of how these insurance exceptions evolve over time and what the events are that shape them, as NotPetya is now shaping them. So if we go back 80 years to Pearl Harbor, right, you see a bunch of life insurance claims after Pearl Harbor, where people who died in the attack have family members who are filing claims under life insurance, and several of the insurers say, well, this actually was an act of war, so we're not going to cover it, right? And it's a slightly different language in the war exclusion, but a similar idea. The idea just being insurers can't predict war, right? War is huge and expensive and incredibly impossible to model. So we're just going to write that out of our policies. But it's also predicated on this idea that war is kind of rare and kind of unusual, which I think is arguably less true of something like a Russian cyber attack on computer systems. Pearl Harbor happens, a bunch of insurers say, we're not going to cover this, it wasn't war. And the argument there is it's not war because the US Congress does not officially formally vote to declare war on Japan until the next morning. Right, so there's this big attack on Pearl Harbor. Technically, the United States is not yet at war with Japan. Of course, as soon as this happens, the United States immediately goes to war with Japan. But the insurers say when this happened, or the insurers say this was war, and the families claiming these life insurance policies say, no, this was this was obviously not war. It wasn't declared until the next day. And you get a whole bunch of rulings in the 1940s that have to do with, well, what is war? So here's a court in New York saying you don't need a formal declaration of war. That's not what the existence of war is dependent on. It applies that word in general to every situation that ordinary people would commonly regard as war. So here's a court saying, you know, war is anything that looks like war, including a big attack on Pearl Harbor. Here's a different court in Idaho saying, actually, this is a legal contract, this insurance policy. It doesn't matter if, you know, journalists in the newspaper are calling Pearl Harbor an act of war. What matters is the formal legal definition of war, which really, in the eyes of this court, does depend on Congress making a formal declaration. And so in the eyes of this court, it seems quite obvious that words and phrases in a contract of this nature are used and intended to be used in the legal sense. Here you have the court arguing for a very narrow definition of what is and is not war. Here's the New York courts again saying this is definitely war. You have a sovereign nation attacking another sovereign nation with premeditated and deliberate intent. We have war in the grim sense of reality. So depending on kind of which model you're following, is it a sovereign nation attacking a sovereign nation? Is it a formal declaration? You can think about sort of the question of NotPetya in very different ways. One thing that comes out of these cases in the 1940s is that all of the insurers start changing the language in their policies so that you get the language in the exclusion from Zurich, right? This hostile or warlike action in time of peace or war, that in time of peace specifically enters everybody's language after Pearl Harbor. They're saying it wasn't a time of war technically, but still it's a hostile or warlike action, expanding that definition. You get another big case in the 1970s. There's a Pan Am flight that's hijacked over Europe. The hijackers fly the plane to Cairo. They end up sort of getting everybody off the plane, and then they explode the plane. And the airline, Pan Am, files a claim for the cost of the airplane, which is several millions of dollars. They file the claim with Aetna, and Aetna comes back and denies the claim and says this was essentially an act of war. But the war exclusion has really expanded by the 1970s. So here's the exclusion language in Pan Am's coverage. It says we're excluding any sort of attempted threat, any war, invasion, civil war, revolution, rebellion, insurrection, warlike operation, right? You see the insurers really trying to cover all their bases here. Pan Am sues, and the court goes through this exclusion and says, no, I don't think this hijacking is any of these things, right? And I pulled some excerpts there to show you how they do that. They say, well, this is not a government, right? These are some, independent terrorists who are hijacking this plane. So it can't be considered war or a warlike operation. They'd say it's not a warlike act because the hijackers did not wear insignia. They didn't carry arms. They didn't have military overtones. It's not an insurrection because the Palestinian group that was doing it did not intend to overthrow a government. It's not a civil commotion because there wasn't disorder. There wasn't a big gathering. It's not a riot because there were only two people who were doing it, right? So they go through and the court says, no, this isn't sort of anything in your war exclusion. You do have to pay for this. And then again, the insurers go back and they rewrite their exclusions to make them a little broader. Two more cases I want to touch on quickly. One is a Holiday Inn building that's damaged during the Civil War in Lebanon. The insurers Aetna again, and they're like, all right, okay, this time we're definitely going to win because this is really a civil war. Everybody calls it a civil war. They go to court when Holiday Inn sues them, and the court says, no, this was a series of factional civil commotions of increasing violence, right? But there was no kind of attempt to overthrow the government. There was no war in the sense of conflict between sovereign states. And the reason I'm giving you this history is I want you to understand why the insurers look at NotPetya and think that it's a really opportune moment. Because they can say, okay, this is conflict between sovereign states, right? Whatever else the courts may have said in the past, at least we've got that. The last case is a much more recent one that I want to touch on. It's a television series called Dig that was being filmed by Universal Studios in Jerusalem when there were a series of rocket attacks by Hamas in 2014. The studio goes to court against its insurer, which refuses to pay for the costs of moving production somewhere else. And again, the court comes back and says, no, warlike action requires sovereign governments, requires something that is actually, two governments coming into conflict with each other. And instead, what we have here is intentional violence against civilians, right? Which would also be sort of one way to think about some of the effects of NotPetya. So you get a fairly long history of these war exclusions in court. The history is very strongly against the insurers, I would point out. That's also what we've seen so far in the cases by Merck and Mondelez, though those are both still ongoing. This was from a ruling late last year in December of 2021 in the Merck case against its property insurers, which the court said, Merck says that its reasonable understanding of this exclusion involved the use of armed forces. So here's a new twist, right? The court's not even going to take up the question of was this sovereign governments, we'll just concede that. The problem with NotPetya, they say, is there's no violence. There are no armed forces here. There's, nothing that looks like war. At least Pearl Harbor looked like war. There were explosions, there were people dying. And then the court notes the insurers haven't changed the language of their war exclusions to reasonably put this insured on notice that it intended to exclude cyber attacks, even though they had the ability to do so. And having failed to change the policy language, Merck had every right to anticipate that the exclusion applied only to traditional forms of warfare. So now, inevitably, what you're seeing is insurers scrambling to change that language. And you've seen this just in the past month or so, with Lloyd saying we're going to start excluding state-backed cyber attacks and things like that. I think there's a very weird dynamic here, and I just want to take one or two final minutes to bring this up around the ways that exclusions are being rewritten. Right, so here from 2019, we have the sort of Zurich rewriting of its exclusion after NotPetya, in which they're saying, any warlike action against any target by any government, sovereign, or other authority using military personnel or other agents. So you see perhaps a broadening of who can be involved, not just governments and sovereign, not just military personnel, but other agents. Somewhat relevant for certain kinds of cyber attacks in certain countries. But you also see, because policyholders get scared that nothing's going to be covered, these explicit inclusions of cyber terrorism, right? So Zurich at the same time is saying we will cover the use of information technology to execute attacks or threats by any person or group, including those that are acting on behalf of or in connection with organizations or governments that are intended to cause harm, intimidate any person, or cause destruction to critical infrastructure. So you see the insurers really trying to have it both ways, to say we're only excluding war, we're not excluding terrorism, even though I would argue these two definitions arguably overlap in a lot of places, depending on sort of whether you consider something an act of cyber terrorism or cyber war. Some of the big differences here, right? The war definitions rely much more on attribution, being able to say this was a government that did this, whereas the terrorism definitions are much more about the impacts, things like did it cause harm, did it destroy critical infrastructure, things like that. I think there are a lot of advantages to using those cyber terrorism definitions, but I think there are a lot of disadvantages to sort of doing both of these at the same time and trying to have it both ways. And tell your policyholders, we're including everything you care about. We're only excluding the really big, really rare sort of cyber war events without having very clear definitions of which is which. And then finally, because I'm a policy professor, I usually try to wrap up with some policy recommendations. So some things I think would be helpful here are clearer definitions of what qualifies as cyber war. Is it about state-sponsored attacks? Is it about cyber physical attacks where you see some physical destruction or damage? Is it about some dollar threshold that you say anything more expensive than this is an act of cyber war? I think clarifying that would give the opportunity for government agencies to come in and talk about what they'll help cover, which is something the insurers have been pushing for a long time. And the goal, I think, would then be to have those two meet in the middle. So for instance, if you buy war insurance from a government, which is a thing that some of them sell, then usually your private insurance comes right up to the point of everything that your war insurance doesn't cover. And right now we don't really have that system in place for cyber because we don't have very clear definitions of what is or is not war. I think clarifying that backstop and then using that to clarify what private insurance will and won't cover could at the very least help sort of set some signposts for policyholders about what they will and won't be able to claim under their cyber insurance policies, though it doesn't necessarily solve some of the larger issues of whether insurers are going to be able to model and predict these attacks well enough to maintain the kinds of loss ratios that they need to keep selling cyber insurance. So let me stop there, and I'm gonna stop screen sharing as well so that I can see you while we do questions. I think I've left some time, and if we have too many questions, then I'm happy to stick around for a little and do some more.